In this video, I'm going to show you guys how I managed a trade that was actually not going my way, that was actually going against me. And I'm going to show you exactly step by step how I managed this trade and how I minimized my risk during this trade, how I was able to exit the whole trade still with a profit. So this example is actually an example from my live portfolio, which I'm sharing with my community. And this is going to be about Deckers Outdoor. I'm sure a lot of you guys will know Deckers Outdoor under their brands, which is mainly Hoka and UGG. I'm sure that my feminine community is going to know the UGG shoes, the shoes that a lot of women wear in the winter, I believe. Now they also make summer shoes, or they make shoes for men as well. I'm actually a big fan of their sports shoes. I like them. But let's go into the trade. So I originally sold a Deckers Outdoor $95 strike cash secured put on April 20 and also another one on April 21, and both of them were supposed to expire on May 22nd, okay? And for this commitment, I collected $210 in premium. So let's go over some words here, which is very important to understand. So whenever you sell a cash secured put, you receive money because we are selling a commitment. Okay, we are basically ensuring the market to possibly buy 100 shares of a stock at a strike price, which is going to be $95 at a certain expiration date if that stock ever drops there. So if we sell a cash secured put, we receive money, which in this case was $210 per contract. And if we close a trade, we buy back that commitment and then we spend money, okay? That is very important to understand for this example. So as you guys can see, I sold these cash secured puts up here and I collected a very nice premium up here. And Deckers Outdoor was supposed to report earnings on the 28th of May. That's why I sold the cash secured put expiring before this date, because you never want to trade a cash secured put during the earnings or over the earnings, because a lot can happen during the earnings, okay? A company can miss their earnings goal or they can even beat their earnings goal, but they can give a not so promising forecast and then the stock might still drop a lot. So earnings generally is very unpredictable. That's why I sold a cash secured put which is going to expire before this earnings date. However, Deckers Outdoor changed their earnings date from the 28th to the 22nd, and as we can see here, their earnings date were supposed to be on the exact same day as my cash secured put is going to expire, okay? And that was just way too risky for me, because to protect your capital is the number one rule, and I am not willing to take any risk to lose my capital or for the stock to potentially drop way below my strike price and I end up having to buy Deckers Outdoor at $95 if it, for example, drops to $80. I don't want that to happen. So for my risk tolerance, this risk was too high, and Deckers Outdoor is a very strong but also volatile growth stock. So what that means, Deckers Outdoor moves up and down a lot, okay? They're actually profitable, but their main focus is growth, and therefore it's a very volatile stock with a lot of movement. So a huge drop is even more possible than any other stock if we, for example, compare this to Walmart or Kroger, because these stocks are considered more conservative, okay? So, as you guys know, I always want to minimize the risk, so I decided to roll my cash secured put down and out. I decided to roll down and out. And what that means, I'm going to explain here, okay? Later on, I have a full calculation that I'm going to share with you guys. But what I basically did is I bought back for minus 443 per contract. Okay, my calculation is going to be per contract. You guys can multiply that on as many contracts as you want, because as we know, this is just a numbers game. It's a percentage game. So my calculation is going to be per contract. But I bought it back for $443. So this is money that I actually spent. And I sold a new cash secured put at a $92 strike, which is down, okay? Because as we can see, $92 is lower than $95. So that's going to be considered down, as that price is below that. And I chose a new expiration date, which actually added value to the contract, which is June 22nd. Before, it was supposed to expire on May 22nd, and I rolled it out. Okay, so down, lower price, out, longer time that this contract is running. And for this commitment, I collected a new $458 in premium. So now I'm going to show you guys the full calculation on this trade. So here I have the calculation per contract. Okay, so I sold 2 contracts on this, which I shared in my live account with my community, but you can multiply this on as many contracts that you want to sell. This calculation is just on 1 contract. So here's what I did. Originally, I collected $210 in premium. Then DEC changed their earnings date, and therefore the risk for me of a huge possible drop actually increased. So I decided to buy it back for $443. So this money I received, this money I spent. When I bought it back, I immediately rolled down and out, and therefore I collected a new cash secured put. So I sold a cash secured put, I received money, I bought it back, I spent money, I sold a new cash secured put, rolled down and out, therefore collected a new premium, and then the earnings actually passed. So Decas Outdoor actually ended up beating their earnings, and the stock actually rised a lot. So it went all the way back up. So looking back, you could have said, hey, you did all of this effort to minimize your risk, but actually Decas Outdoor went up. Well, everyone can say something like that looking back, but in the moment when you don't know the future, you want to minimize your risk. So we never want to be that trader that is always saying very smart things looking back at something. We want to operate and manage in the very moment that we are in the trade. Okay, so Decas Outdoor actually reported their earnings. They beat their earnings and the stock went up. And then on May 22nd, I bought back the cash secured put, which was actually the earnings date. Okay, I bought it back for $120 because I just wanted to close the trade. I had to adjust this trade. I was able to close it for profit in that moment because, as you guys can see all the way down here, it is $105 in total profit after all of this. Originally, it would have been $210. Okay, so it would have been much more than $105. But I don't care if on this trade I collected less profit, because I managed to get out of it profitably, and I was able to absolutely minimize my risk during this trade. So yes, this is only like half of the profit from up here, but it is profit, and I protected my capital. To go over the calculation once again, 210 plus minus 443 plus 458 minus 120 to then finally close it leaves me with a profit per contract of $105. And I sold 2 contracts here, so I have a total profit of $210. Okay, still a nice profit while minimizing my risk and protecting my capital. And this is exactly what I teach in my community, the premium cycle, where I have a full course of how this strategy works so you understand it in detail. And we also have a live chat where I am sharing my live trades so you can benefit from that. And you can also ask any type of questions and thoughts there. And we are helping each other in my community. So if this is something that you're interested in, if you want to make a passive income while protecting your capital, you can join my community, click the link in the bio, and I will see you there.